Hi, I'm Kevin Cummins. I'm the Chief US Economist at NatWest Markets, and I was going to take you through a couple of bullet points ahead of Wednesday's FOMC meeting. There's going to be a lot of information released from the Fed. At 2 o'clock, we'll get the policy statement along with updated monetary policy projections from the Fed, or the so-called dot plot. And then at 2:30, Fed Chair Powell start his press conference. As far as expectations going into the meeting, recent comments from Fed officials don't suggest any major policy changes are likely to occur. We still think that Fed officials want some time to see how things unfold with regard to COVID. And right at this time, they're not ready to decide on changes to forward guidance just yet. They'd prefer to see how things shake out in the overall economy and have a little bit better of a handle that changes to forward guidance, in our view, are not imminent. It's possible that Fed officials could alter the language a bit around their asset purchase program in the statement, from a focus of smooth market functioning to providing more accommodation is probably something that we're going to hear about on Wednesday. That said, I think that the expectation, at least from our perspective, is the Fed's not going to alter the actual program at this time, whether it would be longer dated or increased size in purchases. We think that the Fed's going to stop short of that and only change the language about the purchases themselves, and in that they're more designed to provide accommodation and maintaining monetary policy accommodation rather than the earlier emergency of a smooth market functioning. Meanwhile, the post-statement with regard to the economic outlook is unlikely to be changed all that much. We're not really looking for many meaningful changes to the takeaway here. Economic conditions are likely to point towards the softer side of the economy that we've seen, and particular with regard to employment growth. While it's been an impressive pace of job growth, Fed officials may acknowledge some moderation since the July FOMC meeting. Outside of that, I think one of the things that they're likely to replace is some of the language with regard to a symmetric 2% inflation objective. At Jackson Hole, obviously, Fed Chair Powell adopted and made an announcement that the FOMC has adopted flexible average inflation targeting. And I think they're going to start to weave in some of the language from that approach into the FOMC's statement that acknowledges that the Fed is trying to achieve inflation that averages 2% over time. Given that the changes to the statement are more or less just kind of housekeeping issues and not necessarily unveiling anything new in a change in policy that's going to be announced on Wednesday, I think probably from the market's perspective, one of the more interesting things will be the updated dot plot. And I think officials are going to reinforce the message that current zero lower bound interest rate policy is going to remain appropriate in their view through 2023. This set of projections will extend out one more year from what currently they're estimating, so that it'll include 2023. And we think that the median dot for 2023 won't show any rate hikes through the forecast horizon. One of the things is that now that the Fed has adopted this average inflation targeting, they're going to need to see inflation on a sustained basis move above their long-run 2% target. So in their forecast, we don't expect them to show inflation moving all that much, if anything, above 2%. So if they're true to their word and they expect to adopt this average inflation targeting going forward, then that sort of backdrop would not allow or would not be consistent with the idea that they have any rate hikes throughout their forecast horizon. So I don't expect any of the FOMC members to show any rate hikes through 2023. Meanwhile, we'll also get the longer run dot. There's a chance that that longer run dot, which has been moving down for quite a while over time, which has steadied in the more recent couple of projections at 2.5%, does drift lower again to perhaps as low as 2.25% on Wednesday. It'll take just 3 FOMC members forecast to push that dot down to 2.44% if they're looking at 2.5% as of June, and they're going to switch that to 2.25. It'll only take 3 of those guys to move that long run estimate down to 2.44%. However, if 5 of the officials out of the 8 that were expecting 2.5 move it down to 2.25, then the median term dot will move down, all else being equal with the other dots, down to 2.25. So I think there's some risk and some scope that 2.5% median dot does move down. And I think the market would interpret that as consistent with the new message from Fed officials of average inflation targeting, that they're going to be very slow to raise rates. They're going to need to see inflation move moderately above their 2% target for somewhere in the neighborhood of about a year before they're comfortable with raising rates. So I think the takeaway here is we're going to get a pretty dovish outlook from the Fed, and I think the recent approach to average inflation targeting signals this. Outside of that, I think the vote is going to be unanimous on all fronts. I think the FOMC is very much in lockstep with the chairman right now. We'll also get the summary of economic projections in this latest batch of information from the Fed. I think that the improvement that we've seen in the recovery has probably been a little bit quicker than most expected, so that the earlier estimates on GDP growth may not be as severe of a drop in 2020 as expected. So as of June, they were looking for about a 6.5% drop in real GDP in 2020. I wouldn't doubt that you're probably likely to see a less severe drop, somewhere perhaps in the neighborhood of about 4% drop in 2020. And then perhaps they may inch up their number for 2021 a little bit to show a little bit more of a recovery next year. Outside of that, the inflation backdrop is unlikely to change all that much. And then I think with regard to the unemployment rate, as I mentioned, the steep drop that we saw in August is likely to carry over to their numbers, that we're going to probably see some marking down of their estimates of long run, the next couple of years of the unemployment rate, but not necessarily change to the long run estimate. As of June, that was at 4.1%. And I would expect that would be the conclusion at the September meeting as well. Okay, well, I appreciate your time. We're going to be recapping the FOMC meeting at some point after Wednesday. And I look forward to giving you my latest thoughts and views in the wake of the FOMC meeting. Thanks for your time. Appreciate it.